current economic situation of the world is quite grim. Inflation is at sky-high levels. Most relevant economies are in recessions, and an unforeseen war has made everything much worse. Today, we'll look back at Cathie Wood's economic forecasts, specifically inflation and deflation from 2021. Cathie Wood is a well-known investor and CEO of Ark Invest, an asset management firm with billions worth of assets under its management. We've recently covered Cathie in a recent video, but today, we will look back at her outlook from a year ago. Thank you for continuing to support our channel. Let's dive right into the video.
Well, the stimulus, the first part of it is in place. We're seeing it come through the economic statistics as well. And it does look like we're going to get somewhat of an infrastructure bill, which may include tax increases, but I think the odds there are going down. The closer we get to the midterm elections, given how razor thin the margins are in both the House of Representatives and the Senate, the lower the likelihood of significant tax.
In this first clip, Cathie Wood takes note of COVID stimulus packages and the small possibility of additional taxes. In this next clip, she discusses inflation briefly.
It does seem, according to the University of Michigan, that inflation expectations have picked up a bit when looking at a 1-year time frame, but looking at a 5 to 10 year time frame, inflation expectations are still in the 2.5, maybe a little north of that.
Cathie Wood notes that inflation will grow over the short term, but in the long term, it should remain stable at around 1 to 2%. She discusses the lack of labor force in this next clip.
What is going on if businesses are scrambling and can't meet demand? What is going on is if you pay people not to work, they won't work. And I think a lot of companies are having trouble finding help. And in fact, one of the important clues of that is, and I've never seen anything like this, is temporary employment dropped 111,000 in 1 month. What does that tell us? It tells us, though, that those companies who have hired temps and realize they cannot find employees on a permanent basis, they are luring the temporary employment, the people who are working for them temporarily, they're luring them in probably with some pretty good packages. And what we saw in average hourly earnings would confirm that. Leisure and hospitality is picking up dramatically now. I think the number was close to 350,000 increase in that employment level. Those wages, the wages for that category of employment, are much lower than average. So the mix shift should be pushing down average hourly earnings. Maybe not putting them into negative territory, but flat to up 1 or 0.2% per month. Instead, we got an increase of 0.8%. So the costs are going up to attract labor. We think that's temporary, that when this stimulus package runs out, that will correct. But for right now, that is feeding fears of inflation.
Right off the bat, Cathie Wood says that this failure of companies to meet demand is due to the lack of labor force brought about by the stimulus packages. She says that if people are paid not to work, they simply will not work, which results in a lack of employees. Therefore, businesses struggle to keep up with demand. She also notes that companies have begun permanently hiring their temporary employees, luring them with attractive offers because they know that there is a lack of labor. She also notes that leisure and hospitality-related jobs have begun to pick up once again. However, wages remain at a low. However, salaries have slowly gone up to attract labor, but Cathie says this should only be temporary due once again to the stimulus packages. In this next clip, she discusses several factors that could lead to deflation.
We think that roughly 50% of the S&P 500 is at risk of creative destruction. Some more, some less, but 50%. And what does this mean? What we think is going to happen here, for those companies who spent the last 20 years catering to short-term investors who wanted their profits and wanted them now, companies were leveraging up to buy back shares, pay dividends, and they were not investing enough in innovation. In fact, many didn't take seriously the idea that innovation was a threat. I know when we started Ark in 2014, auto manufacturers, auto analysts thought, this was something for the mid-20s, maybe. And we were looking at the cost declines in battery pack systems, and we were saying, nope, this is happening now. And now we see auto manufacturers scrambling, and we would say they're scrambling for dear life. So we're going to see a lot of that in financial services, energy. So the two sectors that have done best this year, we believe, are two of the most vulnerable sectors. In the energy space, again, up 40% year to date. We think that electric vehicles, and especially autonomous electric vehicles as they launch within the next few years, are going to put a big dent in oil demand. And within financial services, we see digital wallets evolving so much faster than I think anyone could have dreamed. China showed us the way through WeChat Pay and Alipay, and now Square's Cash App and Venmo are moving so quickly that their user base has scaled well beyond JP Morgan's customer base in just a few years, in the last 5 years, whereas JP Morgan got to this level one acquisition at the time. The digital wallet evolution or revolution has gone viral, and there's a social networking element to it. So very interesting space. And so financial services buyers beware. So that's the bad deflation. Those companies that are too leveraged and have products that will be obsolete are going to have to sell those products at a discount increasingly in order to service their debt. So good deflation on one side associated with an innovation, and bad deflation associated with the creative destruction caused by innovation. The third source of deflation that we believe will take place maybe toward the end of this year, probably more likely next year, is commodity deflation. We believe that there is a lot of double and triple ordering taking place right now, and companies never quite know if it is double or triple ordering. I think supply chain management systems are getting better, so maybe it won't be as bad as it has been historically. But we do think that inventories will build to a level well above demand sometime next year, and that the unwinding of them will cause an unwinding of commodity prices. That said, we want to keep an open mind here. When I see a breakout from a 20-year base, as we've just seen in copper, I pay attention. Now, on oil, we have not. And in fact, $140 was the peak in 2008. And every peak since then has been at a lower level. So right now we're at 60, and I believe the last peak we saw was in the either high 70s, low 80s. So I'd be very surprised if we go above that level. If we do, then we will, score another one for the inflation risks are picking up. The other thing we're watching is the dollar. To see the dollar break down would be somewhat concerning. Now, the dollar is priced against other currencies, so part of that is a function, perhaps, of our monetary policies relative to those elsewhere.
Cathie Wood notes that nearly half of the companies in the S&P 500 is on the verge of collapse. She and Ark Invest believe that companies who specialized in shorting stocks were more invested in buying their own stocks and not investing enough in the field of innovation. Cathie believes that financial services and energy are the two sectors that are currently the most vulnerable. She emphasizes this with the uprising of electric vehicles, which she believes will lower the demand for oil. For financial services, Cathie notes the growth of apps like Venmo, which have outgrown JP Morgan's customer base in only a few years. These two sectors are examples of bad deflation, which Cathie refers to as over-leveraged companies and will eventually be obsolete in the future, meaning that they'd have to sell products at lower prices. Another factor that may lead to commodity deflation is going to be the staggering amount of over-ordering that is occurring at the moment. This could lead inventories to reach levels that demand cannot keep up with. Cathie Wood is also taking note of the price of oil, as she said that it has so far not gone past the peak of $140 per barrel in 2008. But she says that if it does continue to increase, it is yet another sign of a forthcoming inflationary wave. Cathie is also monitoring the value of the US dollar. She notes that it is so far doing well due to the monetary policies being imposed in the US. In this next clip, Cathie Wood concludes her thoughts and outlook for the future of the economy.
I will say the country that has handled this crisis the best in terms of not throwing money at it willy-nilly is China. And I think that will accrue to their benefit in the years ahead. So I would say watch that space as well. So with that, I just wanted to call out some of our thoughts. We do believe deflation is the bigger risk. The reason I like being on that side of the bet is that it seems like everyone is on the other side. And usually, if that is true, then if we're wrong, then inflation has been or is being discounted in the market right now. So we'll be perhaps uniquely wrong, and it's good to be uniquely wrong. If everybody else expects one thing, then it's probably getting priced into the market.
Cathie Wood gives credit to China, saying that they have addressed the calamity brought about by COVID without flushing money into the economy. She says that this may benefit them in the coming years, but so far, China has not been doing well with a recent financial crisis striking the country. Cathie also remains steadfast in her view that deflation will be the biggest risk over inflation. Cathie concludes by saying that those sources of deflation that she mentioned will confuse analysts and experts in the coming years. She also says that innovation has the capability to reward its investors with tremendous amounts in the coming years. So how accurate do you think Cathie Wood's forecasts were now that we're in the year following her statements? Do you believe deflation will become a problem in the future? Give us your thoughts in the comment section down below. If you enjoyed this video, give us a like and subscribe, and we'll catch you on the next one.